This video is created by Jagrat Creations. It is on amalgamation of partnership firm. I want to take care of one sum here before you. Just observe the sum on the screen. This is the sum that I intend to solve here before you. X and Y together and Z independently were carrying a separate business. Their balance sheet as on 30th September 2017 were as follows. On asset side, X and Y, cash, debtor, stock, investment in case of Z, motor car in case of Z, machinery and building only in case of X and Y. Creditors for both, bills payable, reserve, overdraft, XY capital, Z capital. This is the balance sheet total. X and Y were sharing profits and losses in the proportion of 3:2. The concerns were amalgamated on 1st of October 2017 on the following terms. That the goodwill of X and Y business is valued at 10,000 and that of Z business is valued at 6,000. That the provision of 5% be made on all debtors. The stock of X and Y be depreciated at 10% and that of Z by 8%. That the machinery and building is taken at Rs 42,000 and 30,000 respectively. The motor car be retained by Z, that the investment taken at 16,000, that the capital of new firm should be 1,60,000, out of which 1,20,000 should be held by X and Y equally, and the profit sharing ratio of the new firm between X and Y Z agreed as 3:3:2. Pass necessary journal entries, prepare necessary accounts in the books of various parties. Also prepare the balance sheet of the new firm. So this is a comprehensive exhaustive sum. You are required to write down the journal entries in both the vendor partnership firm. You are required to prepare ledger accounts in both the vendor partnership firm. You are required to prepare balance sheet ready for sale in both the partnership firm. You are required to write down the journal entries in the purchasing amalgamated partnership firm. So in a new firm, you are required to write down the journal entry. And a new firm, you are also required to prepare the balance sheet. Now, here the goodwill of X and Y is 10,000 and that of Z is say 6,000. So the exchange value of goodwill. Now this sum can be solved by two alternative methods. One method by preparing revaluation account and second method by preparing realization account. The realization account method wherein X and Y partnership firm is dissolved and the realization account is prepared, and in that case whatever the value that you realize for goodwill is credited to realization account. That is the opinion of the institute in its study material. But if this sum is solved not by dissolution method or not by preparing realization account but is prepared by revaluation account, their opinion that the exchange value of goodwill should not be raised. So, if you solve the sum by realization account, the realizable value of goodwill should be credited to realization account. But if you solve the sum by revaluation method, you should write straightway the adjustment entry of goodwill straightway in the books of the new firm. That is the opinion of the institute as per their study material, with which I don't totally agree because there is a discrimination in the treatment. Anyway, I am going to raise the goodwill. I am going to solve this sum by preparing revaluation account. And the goodwill will be raised and the goodwill will be transferred. The exchange value of goodwill will be transferred to the new firm. And after goodwill enters the new firm, the goodwill will be written off at the end so that no goodwill will appear in the balance sheet. That is going to be maintained. The requirement of the accounting standard is going to be maintained even by raising and writing of goodwill. So I feel that the accounting treatment that I go for, raising goodwill and writing of goodwill at the end in the books of new firm by solving the sum by revaluation account method, that is also fine. So I am going to solve this sum by revaluation account method. Now in this revaluation account, what is to be done? Instead of preparing realization account, I prepare revaluation account. The balance sheet of X and Y that is given to you will be converted into a balance sheet that is appropriate for transfer to the new firm. So, all the assets and liabilities that are transferred to the new firm will be maintained in the balance sheet at its revalued value. The assets and liabilities not taken by the new firm will be distributed amongst partners. Any revaluation in the assets and liabilities that takes place, that will be profit or loss on revaluation will be transferred to partner's capital account. Undistributed profits and reserves also will be transferred to partner's capital account. So this is how revaluation method is going to be followed by me. So first of all, I will start with the accounting in the books of X and Y company. So in the books of X and Y company, vendor firm, I'm going to prepare revaluation account. This is new firm's account that I'm going to prepare. This is partner's capital account. Now I start with this balance sheet and the information given to me for the purpose of solving the sum. See, this is a comprehensive exhaustive sum, wherein I'm going to write down the journal entries in the books of vendor firm. I'm going to prepare ledger accounts in the books of vendor firm. I'm going to prepare balance sheet ready for transfer to the new firm in the books of vendor company, in the books of vendor firm. So, first of all, I will write down the capital balance of X and Y. Now, after writing this capital balance, just remember the steps with which I solve the sum. That's very important to be noticed by the students. The first step that I will consider the revaluation adjustment, distribute revaluation profit or loss amongst partners in the ratio of their profit sharing. Now I am given 2, 3 and 4 adjustment. They are pertaining to revaluation of assets and liabilities. The first, the provision of 5% be made on all debtors. Debtors are 14,000. 5% of 14,700. This provision is to be made for that revaluation account is to be debited. And this bad debt reserve will appear on the balance sheet. 700. If I want to write down the journal entry for that, revaluation account debit to provision for doubtful debts account is to be credited. This is how the debit effect is given, demonstrated in the balance sheet. Journal entry is also recorded with that. Revaluation account debit to reserve for doubtful debts account credit. Next, stock of X and Y depreciated by 10%. Stock is 22,000. 10% decline there in 200. 200 decline in the value of asset loss debited to revaluation account. The new value of stock will appear in the balance sheet. I am going to write down the journal entry revaluation account debit to stock account credit 2200. This is how journal entry is also recorded simultaneously. Now, total of these two, 2200 and 700, 2900. Revaluation account debit to reserve for doubtful debt and to stock account credit. This is how the journal entry in the books of vendor firm is recorded for decline in value of asset that is debited to revaluation account. Machinery taken at 42,000. 38,000 is the book value. Exchange value 42,000. Increase in value 4,000. Credited to revaluation account. The new value recorded in the balance sheet 42,000. Journal entry. Machinery account debit to revaluation account credit. Now, let me take care of building. Book value 26,000. Exchange value 30,000. Increase 4,000. Revaluation account credit. New value of building recorded in the balance sheet. So, building account debit 4,000 to revaluation account credit. Total of these two 8,000. Being increase in the value of machine and building accounted for 8,000, revaluation account is credited. So revaluation account is debit and credit effects are given. Now let me find out the revaluation profit, and that will be distributed amongst partners in the ratio of profit sharing. So total of credits at 8,000 minus 2,900. This will be distributed in the profit sharing ratio, that is 3:2. 5,100 into 3 by 5. 5,100 into 2 by 5. Revaluation account debit to partner's capital account credit. Let me write down the journal entry. Revaluation account debit to X capital account, to Y's capital account, being revaluation profit transferred to the partner's capital account in the ratio of profit sharing. So this is how first step is done. First I recorded the capital balances, then I consider the revaluation adjustment. Revaluation account is prepared. Profit or loss on revaluation transferred to the capital accounts of the partners, and the revalued value are recorded in this balance sheet. Now next step, transfer reserves. Reserves are 15,000, that will be distributed in the ratio of 3:2. 15,000 into 3 by 5, 15,000 into 2 by 5. Journal entry. Reserves account debit to X capital to Y capital. Capital accounts are credited for that. This is how step 2, transfer of reserves is done. Because reserves are not sold to the new company. Here I am going to prepare the balance sheet that is ready for sale to the new company. Next, goodwill. Goodwill of X and Y, business valued at 10,000. Increase in value of goodwill 10,000 will be credited to the partner's capital account in the ratio of profit sharing. 10,000 will be distributed in the ratio of 3:2. Partner's capital account is credited and the goodwill appears in the balance sheet at 10,000. Journal entry for that. Goodwill account debit to X capital account to Y's capital account. Being goodwill raised. So this is how third step is done. Fourth, assets not sold to the new firm. Here all the assets are sold. So no entry for this point. Liability is not transferred to the new firm. Here also no such case is there, no such transaction is given, so no entry. Now close the capital accounts. They have to be transferred to the new firm account. So this is the balance sheet. In light of all this adjustment, the balance sheet total should change. 122,800. Now this balance sheet is ready for transfer to the new firm. All the assets, liabilities and capital account will be transferred to the new firm. For that transfer, I will write down the journal entry. That's an important point of this sum. So entry for assets transfer to the new firm. New firm account debit to goodwill, to cash, to debtors, to stock, to machinery, to building. And new firm account is debited with the assets given to the new firm. New firm is the receiver, debit the receiver. So new firm account is debited, all assets account is credited. Now next, entry for liabilities transfer. So bad debt reserve account debit, creditors account debit, bills payable account debit to new firm account credit. All the credit liabilities and provisions transfer to the new firm. New firm account is credited for that. Now transfer of capital balance. X capital account debit, Y's capital account debit to new firm account credit. The total of new firm account on both the sides will be same, 122,800, 122,800. This is the balance sheet that has been sold to the new firm. So all assets balances are transferred to the new firm. So new firm account is debited with the assets. New firm account is credited with the reserves, liabilities transferred and the capital transferred. This is how journal entries in the books of vendor firm are recorded. All necessary ledger accounts are prepared in the books of vendor firm, and also the balance sheet ready for transfer is also prepared in the books of vendor firm. So this is a sum wherein I have tried to demonstrate all these things in one sum. So it's an important sum. Now let me demonstrate all this what we have done. All journal entries at one place. So this is how I have recorded all these journal entries while explaining the sum. So these are the journal entries in the books of X and Y. So now X and Y partnership firm books of accounts are closed. Journal entries are recorded. Ledger accounts are prepared, everything is done. Now I start with Z. Now let us start with Z. Here I prepare revaluation account, new firm account, Z's capital account. First of all, I will write down the capital balance of Z. First step, consider the revaluation adjustments. Provision of 5% is to be made on all debtors. 36,000 into 5%, 1,800. Revaluation account debit and bad debt reserve is credited in the balance sheet, is recorded in the balance sheet. Journal entry for that is revaluation account debit to reserve for doubtful debts. Stock of Z reduced by 8%. So 12,000 into 8%, 960. Revaluation account debit. decreased value of stock is recorded in the balance sheet. Journal entry, revaluation account debit to stock account credit. Total 2760, total of 1800 and 960 debited to revaluation account, already done. Now, this is the narration for first entry. Investments are taken at 16,000. Book value of investment 12,000. Valued at 16,000. Increase 4,000. Credited to revaluation account. Increase in value of asset credited to revaluation account. Investment appears at 16,000. Journal entry. Investment account debit to revaluation account credit. Now I want to close revaluation account. Profit or loss thereon will be transferred to the capital account of Z. Profit is 1240. Revaluation account debit to Z capital account credit. Z capital account is credited. So this is how first step is done. Now take care of reserves, undistributed reserves. There is no reserves to be transferred to Z's capital account. So no entry. Goodwill. Goodwill of Z's business is 6,000. Goodwill account debit to Z's capital account credit. Z capital account is credited and goodwill will appear in the balance sheet at 6,000. Next, assets not taken by the new firm. The motor car is retained by Z. Z is not transferred to the motor car to the new firm. So motor car balance will be transferred to Z's capital account. So Z's capital account debit to motor car account credit. Motor car is given to Z. Z is the receiver. Debit the receiver. Z account debit to motor car account credit. Liability is not taken over by the new firm. Not there. So no entry. Now, after all these things being done, close the capital account and transfer it to balance sheet. So this is the balance of capital account. In light of this balance sheet total should change. 71,040. This is the balance sheet ready for transfer to the new firm. So all the assets, liabilities and capital account will be transferred to the new firm. For that we are required to write down the entries. Assets transferred, new firm account debit 71,040. To goodwill, to cash, to debtors, to stock, to investment. Assets transferred. New firm is the receiver of the asset, debit the receiver. New firm account debit to goodwill, to cash, to debtors, to stock, to investment. Now liabilities are transferred. So bad debt reserve account debit, creditors account debit to overdraft account debit to new firm account credit. Liabilities are transferred to the new firm. Capital balance of Z is also transferred to the new firm. So Z's capital account debit to new firm account credit. So this is the balance sheet ready for transfer to the new firm. All assets are transferred to the new firm. All liabilities and capital balances are transferred to the new firm. So total of this new firm account and this balance sheet total will agree. So if you make a total, you will find the same total. This is how the new firm account and the transfer entries are recorded. Now whatever the journal entries are recorded in the books of Z, let me demonstrate all those journal entries at one place. Just observe. So these are the various entries that are recorded in the books of Z, including transfer entries with titles and everything. Now after recording this, after demonstrating the books of X and Y and the books of Z, how they are prepared, how the journal entries are recorded, how the ledger accounts are prepared, how the balance sheet ready for transfer is prepared, and after the balance sheet that is ready for transfer to the new firm is prepared, how the transfer entries to the new firm are recorded, and how the posting is made, everything is made clear to you. Now I want to record this transaction in the books of new firm. So the new firm has purchased the business of both the old firms X and Y business and Z business. So here I prepare the capital of account X and Y. So this is the new firm account prepared by X and Y, and this is the new firm account prepared by Z. Now all these assets are purchased by me. The vendor firm has sold these assets, new firm has purchased this asset. All the assets purchased will be debited, liabilities purchased will be credited, capital account will be credited. Let me start journal entries in the books of new firm. cash account debit, debtors account debit, stock account debit, machinery account debit, building account debit, goodwill account debit, to reserve for doubtful debts account credit, creditors account credit, bills payable account credit, X capital, Y capital account credit, being the assets and liabilities taken over from X and Y at their agreed value. And I will write in the capital account X and Y, sundries. Now I'll write down the journal entry for purchase of business of Z, cash account debit, debtors account debit, stock account debit, investment account debit, goodwill account debit, reserve for doubtful debts, creditors, overdrafted Z's capital. I will write Z's capital account is 40,240, being the assets and liabilities taken from the business of Z at an agreed value. Now there is a capital adjustment in the new firm. So these are the capital balances so far. Now goodwill is to be written off. Now in the new profit sharing ratio, goodwill should be written off. So total goodwill 10,000 plus 6,000, 16,000 will be written off in the ratio of 3:3:2, because goodwill should not appear in the balance sheet in this fashion. So I write out the goodwill in the ratio of 3:3:2. So 6,000, 6,000 and 4,000 deducted from the capital of X, Y and Z, and it is debited to capital account, so it tends to reduce the credit balance. So the balance after writing off of goodwill is this much. Now in a new firm, partners have decided to keep a capital, total capital to be kept 1,60,000. Out of that 1,20,000 is to be kept by X and Y in the equal proportion, so 60,000, 60,000. And 160 minus 120 is the capital to be kept by Z. So let me write down the required capital. That is also in the ratio of 3:3:2. 60, 60 and 40. Now to keep up this much of capital, how much cash is required to be brought by X, Y and Z? So 60,000 minus 42,060. 60,000 minus 46,040. 40,000 minus 36,240. This is the cash brought. Let me write down the journal entry cash account debit or bank account debit to X capital, to Y capital, to Z capital, being cash brought to maintain the capital. Now I write to the credit side of capital account the cash brought. Now I find the balance in capital account, that will be 60,000, 60,000 and 40,000. That balance is equal to the required capital. Now everything is done. Now let me prepare the balance sheet. Remember, I have already written off goodwill. That's an important point to be noticed. Now I prepare the balance sheet. Now first let me work out the cash balance. Cash balance purchased from X and Y. Cash balance purchased that of Z. Cash brought by a partner in the new firm X, Y and Z. This is a cash brought. So total of this cash will appear in the balance sheet. That is 44,660. So cash appears in the balance sheet 44,660. So this is how cash balance is taken care of. All this cash balance is done. Now debtors total, I write in the inner column because bad debt reserve is to be deducted therefrom. Then I write down stock, total of stock purchased from X and Y and Z. Then I write machinery. Then I write building. Then I write investment. All the assets that I record, I make a cancellation mark. At the end of the sum, I am going to remove this cancellation mark. This is just for the purpose of explaining to the students. Students are not required to do such cancellations in the examination hall, because by that you lose the marks. But being teacher, I am permitted to do all these things to make your understanding quite clear. Bad debt reserve deducted from debtors. Net amount shown in the outer column. Creditors total. Then comes bills payable. Then comes bank overdraft. Now capital balances, you know that 60,000, 60,000 and 40,000 maintain. Now have a total of balance sheet. 2,11,000 is the total of balance sheet. So this is how balance sheet of new firm is prepared. Now I have made this cancellation mark. Let me remove it. So this is how the sum should appear in the books of new firm. So this is a sum wherein I have recorded journal entries in the books of both vendor firms. I have prepared ledger accounts in the books of both vendor firm. I have prepared the balance sheet ready for transfer in both the vendor firm. I have recorded journal entries in the books of purchasing firm. I have prepared the balance sheet in the books of purchasing firm. In examination, generally, at a time, students won't be asked all these things. But as I wanted to explain the concept of amalgamation in an elaborate fashion, I have prepared all these things, and also I have written up the goodwill just to comply with the requirements of the accounting standard. So this is how I have tried to explain you this sum. I feel that you have followed all these things. Thanks to you.